What's up, you guys? My name's Jeremy Burbett, and today I want to talk about how to build the optimal investment portfolio. There's a big secret in the investment world. Investment fund managers can't beat the market after their fees. Warren Buffett has been making this point since 2007 when he challenged Protege Partners, an asset management firm, to a bet of $500,000 for charity. Buffett would invest in a low-fee, passively managed index fund designed to track the market, and Protege Partners would invest in an actively managed hedge fund with high fees. After 10 years, whatever fund with the highest returns wins. At the end of 2017, when the bet concluded, Buffett won with returns of 99% over Protege Partners' paltry 24%. The same pattern applies to almost all actively managed funds. In 2018, the S&P Dow Jones Indices ran a study of domestic stocks to compare their performance after fees against market benchmarks. It found that over a one-year period, 63% of large-cap managers, 54% of mid-cap managers, and 72% of small-cap managers underperformed the S&P 500, S&P Mid-Cap 400, and the S&P Small-Cap 600, respectively. So as a whole, actively managed funds underperform the market over the short term. But what about the long term? Actively managed funds performed even worse over the long term. Over a 5-year period, 76% of large-cap managers, 81% of mid-cap managers, and 92% of small-cap managers lagged their respective benchmarks. Over a 15-year period, 92% of large-cap managers, 95% of mid-cap managers, and 97% of small-cap managers lagged their respective benchmarks. Could it be that a top minority of smart active managers are consistently beating the market, such that you only need to identify a consistently winning fund to ensure you'll beat the market? The S&P Dow Jones Indices also ran a study called the Persistence Scorecard to see if winning funds can consistently outperform the benchmarks to differentiate luck from skill. Out of the top half of funds, only 16% managed to remain in the top half both of the following two 12-month periods, when randomly we would have expected 25%. Even out of funds that were in the top quartile after a 12-month period 2 years prior, only 2% managed to stay in the top quartile in both of the following two 12-month periods, when randomly we would have expected 6.25%. Fund performance is also inconsistent over longer periods. Out of funds that were in the top quartile after a 12-month period 4 years prior, only 0.18% managed to stay in the top quartile through all 4 of the following 12-month periods, when randomly we would have expected more than double that. Maybe outperforming the benchmark in every 12-month period is asking too much, and instead we just want our funds to remain in the top quartile, or at least the top half of funds after our 5-year period. Unfortunately, the results still show a lower consistency than luck. Out of funds that were in the top half after the 5-year period 5 years prior, only 42% remained in the top half, when randomly we would have expected 50%. Out of funds that were in the top quartile after a 5-year period 5 years prior, only 18% remained in the top quartile, when randomly we would have expected 25%. Known as the SPIVA scorecard, the S&P Dow Jones Indices releases the same study every year. And year after year, it shows that active managers don't beat the market after their fees over long periods. And those that do can't do it consistently, making the case that it was due to luck. Therefore, investors are better off investing in funds that track the market for as low of fees as possible. Such funds are called index funds. A large number of investors resist investing in index funds because money is very personal, and they believe they should strive to be better than average. But as Burton Malkiel, a famous economist and writer, puts it, it's true that when you buy an index fund, you give up the chance to boast at the golf course that you picked the best performing stock or mutual fund. That's why some critics claim that indexing relegates your results to mediocrity. In fact, you are virtually guaranteed to do better than average. He further explains, why does indexing outmaneuver the best minds on Wall Street? Paradoxically, it's because the best and brightest in the financial community have made the stock market very efficient. When information arises about individual stocks or the market as a whole, it gets reflected in stock prices without delay, making one stock as reasonably priced as another. If fund managers can't beat the market after their fees, how do they make money? Fees. This means your goal in selecting assets for your portfolio should be to mimic the market with as low of fees as possible. Even a 1% fee can drag down your compounding considerably in the long run. A $100 balance with over 30 years compounded annually in a fund charging 1% fees would yield over $135,000 less than it would in a fund charging 0.25% fees. In addition to high fees, volatility can also wreak havoc on your medium-term investment results. This table shows 5 examples in order of increasing volatility of the impact of dispersed returns on a $10,000 balance. The simple average return for each example is 10%, but the compounded average return is lower the higher the volatility. The lower compounded average return associated with higher volatility is caused by one of two reasons: experiencing your high returns too early when your portfolio is small for less compounded return, or experiencing your losses too late when your portfolio is large for more compound loss. For these reasons, you want to try to reduce volatility by diversifying your investments. For example, investment in both domestic stocks and international stocks is likely to yield an overall steadier portfolio than a portfolio built entirely from either asset class alone, since these two asset classes' values sometimes diverge trajectories, with one upwards and one downwards due to market forces. Even though both asset classes can expect roughly the same return, the combined portfolio experiences less volatility. This is the primary conjecture of modern portfolio theory, which assumes the market is efficient, and we already showed it's too efficient for active managers to beat. And it states that a rational investor who cared about minimizing volatility while maximizing returns should own the so-called global economy portfolio. The idea basically says that the collective wisdom of the crowd will beat the risk-return ratio of any given individual, because if it was clear that a given asset has a higher risk-return ratio than others, the crowd would find a way to invest more money into those assets. So following the investment proportions of the crowd channels more money into better assets, while benefiting from diversification of having multiple assets. By diversifying your assets, you participate in what is known as the efficient frontier. The efficient frontier is a way of representing optimal risk-reward trade-offs. Any portfolio that can be constructed will fall under a curve. Portfolios on the curve will have optimal risk-reward trade-offs. Portfolios under the curve could get either more return for the same amount of risk, or less risk for the same amount of return. The way to stay on the curve is to build your stock portfolio proportional to the global economy portfolio. And the way to increase or decrease your risk is to increase your exposure to the stock market, or decrease your exposure to the stock market by putting a percentage of your portfolio in a safer asset like bonds. Notice there is a limit to how low your stock market exposure should get before risk increases again. But covering how to use bonds to decrease our risk is a topic for another video. In this video, we'll go over how to participate in the efficient frontier by making your stock market portfolio match the global economy portfolio. US stocks make up about 45% of the global stock market capitalization, according to the worldbank.org. So to match the global stock market portfolio, you should allocate 45% of your stock exposure to US stocks and 55% to international stocks. But there are two industries in the economy that aren't proportionally represented in the public markets. The biggest of which is real estate. While reflected in total stock market portfolios, real estate represents about 13% of the economy, with only about 4% traded on public markets. Therefore, to reflect the total economy, you'd want to add an additional 9% allocation to real estate. Additionally, venture capital investments, representing about 3% of the economy, are not traded on public markets. The best proxy for venture capital is small cap value index funds. Therefore, it's advisable to have a separate small cap value index fund represent about 3% of your stock market allocation. With these industry tilts, your portfolio will more accurately represent the broader crowd investments, instead of just the investments made available to the public markets. Altogether, the optimal stock market portfolio to match the global economy becomes 48% international stocks, 40% US stocks, 9% real estate investment trusts, and 3% small cap value. As your investments experience gains or losses, your portfolio's allocation percentages will deviate from your target. Therefore, you should rebalance your portfolio at least once a year. Oftentimes, your investment administrator will provide an automatic rebalancing service that you can sign up for that will rebalance your portfolio to your target percentages on a regular basis. If it doesn't offer automatic rebalancing, check in yearly to ensure you sell your funds above your target percentage to buy those below your percentage. There's evidence that rebalancing among asset classes with similar returns, such as between domestic and international stocks, increases returns because of the regression to the mean, a tendency where volatile, uncorrelated assets trend toward their expected return. And so realizing gains from your winning stocks and investing those gains into your now cheaper losing stocks can earn you more than the combined expected return of those assets. Now that we've picked the optimal asset allocation, we now need to pick which funds to use to represent those assets. There are three institutions that offer low-fee index funds that we can choose from: Vanguard, Fidelity, and Charles Schwab. Any of the three will do, but I prefer Vanguard because they're structured such that their fund shareholders own the company, so unlike Fidelity and Charles Schwab, they have no third party demanding a profit, and therefore no incentive to charge you more than necessary to operate their funds. Yes, Fidelity and Charles Schwab do offer some lower fee funds, but Vanguard is already so low that there's diminishing returns to going lower, and I don't trust Fidelity or Charles Schwab to always offer their funds so cheap. While I personally use Vanguard's website, I admit their website is a bit confusing and outdated. So if you prefer a more sleek user interface, you might want to use M1 Finance and just build a portfolio, which they call pies, with Vanguard funds. Regardless, the funds I use are 48% VTIAX or VXUS, 40% VTSAX or VTI, 9% VGSLX or VNQ, and 3% VSIAX or VBR. The first fund in each group is structured as a mutual fund, and the second fund in each group is structured as an ETF or exchange-traded fund. Either of the two work, they're invested in the same investments. It just depends which type of fund your platform offers. That's all for today. Love you guys. See you next time. Be sure to smash that like button, subscribe to see my next video, and comment down below, and I'll be sure to respond.